Coakley said she is working with legislators to try to protect people who took out subprime mortgage loans with ballooning payments. In some cases, she said, homeowners weren't given proper documentation about how the loans would change.
Inventory.
One of the local issues, I think it affects everybody, is one of the reasons that I wanted to have you in there is because of the subprime lending. And if you could address that, because it's just, everybody hears about it now, and there's a growing sector of homeowners who are in that marketplace that you know, they think they're getting a heck of a bargain with a 3-1 arm or a 5-1 arm, and suddenly realize that, you know, they're paying $400, $500, $600 more.
Yep.
What is it that you're intending to do, and what are these hearings going to do?
One of the things I've started doing is Attorney General's read the Wall Street Journal, which I did not do as DA, I'll be honest with you. Except
another Murdoch paper.
Except on Saturdays. Yeah, that's right. You know, in a nutshell, and I have the advantage, I guess, of coming at this, you know, sort of with a clean slate, but it's pretty clear to me that this began when there was a lot of money and credit was easy, and everybody played a role in this. Wall Street Journal has an article today saying even Standard & Poor played a role by, you know, rating these piggyback mortgages where people were borrowing money from one bank to put a down payment on another loan. You know, just created this problem that people frankly knew or should have known. But you know, if you want to follow it up the chain, you had a long period of time where, you know, money was, there was a lot of money, credit was easy, and so you had this proliferation of either low documentation or no documentation loans, overappraisal of people's income, underappraisal of properties, and the local bank, who in the past would want to make sure that their loan was secured by both the ability to pay and the value of the security of the loan, the house. These all get sold up the chain, and now they're securitized, and you're seeing it already all the way through Wall Street and the hedge funds, some of the house of cards here, because I think people were very sloppy about it. What the first part of this house of cards to fall, though, was when people had, as you said, Jack, those loans. You know, for the first 2 or 3 years, the payment's manageable. Now there's a balloon, and now every month they can't make those payments, so there's a foreclosure on their home. In some instances, and one of the first things we went after were the foreclosure rescue schemes. Here are all these people about to lose their homes because they can't pay, and now someone else comes in and says, oh, you know, snake oil salesman, I can help you out. Pay me a fee, give me the deed to your house, and we'll work this all out.
When does a temporary ban go? When is that lifted?
Actually, 90 days goes through August 31st, and we've filed notice that we intend to make that a permanent
Can
reg.
you do this? You need to hold hearings to...
We do, and we have noticed a hearing for the 31st. We will have a hearing that day. I think the expectation is that as a result of that, that is one thing that nobody disputes should be unfair and deceptive per se. So that's the effect of that regulation.
So you can do that. You don't need the Division of Banks. Or
no. I mean, we could potentially be sued for any of these, and I understand that, but we do have the authority under Chapter 93A if we follow the process. In this instance, we did the emergency reg, which was a little different, but we did that based on our experience over the last couple of years of bringing suits against these predatory foreclosure rescue schemes, which is just a side piece of the subprime. But in these other mortgages, the other 4 regs that we have rolled out address what we have seen from the consumer point of view. Now, we don't regulate banks, but we can generate regulations that are consumer protection. And so the 4 areas that we have looked at deal with the no documentation or the low documentation loans would require under Chapter 93A the lender to just provide more documentation. And it's interesting because, you know, I follow this and I hear a lot of people saying, well, I got a mortgage and I had to read 600 feet of paper and I knew that if I didn't pay I'd lose my house. But for a lot of the loans we're talking about, that never happened. People on the phone, they get a sheet of paper, there isn't any of that. And you can argue that, you know, if you've been through it, you say there's so much paper, it almost is meaningless because you don't read it or you don't know about it. But that all got dispensed with and people weren't understanding what was going on. And then when the money starts getting tighter and the people are being credits a little bit harder to get, people start to refinance and then they can't. So there's that piece of it. The other is looking at some of the behavior of the brokers who purport to be in the borrower's interest. And one of the regs deals with the broker has to disclose what his interest is. And working on one loan or another, whether he gets any advantage, monetary or other advantage from selling one product rather than another. And really the loan would prohibit him from making a loan that's not in the buyer's best interest. That is, disclosing the fact that, after year 3 or 4, interest rates balloon up. If you look at the documentation of John Smith and the value of his property, and reasonably know at that time this person isn't going to be able to afford it, you're not supposed to make that loan. So they are consumer protection